So let's talk about credit cards and consumer loans. The first thing I want to emphasize is that you cannot borrow your way to financial success. You can't just spend money that you don't have and create wealth from that. The use of credit, specifically of credit cards, is much more limited. Basically, it's just to pay for things that you can already afford, that you would have bought anyway, only that you make those purchases on the credit card in order to build up your credit score. I would never advocate carrying a credit card balance, that is, making a big purchase and paying it off over a number of months, because the interest rates on credit cards and other consumer loans are just way too high. So unless it's an emergency or an extreme event, as a rule I would advocate not spending more than you can afford to pay off each month. So pay off all of your credit card balances in full each month so that you don't get hit with those 20+% interest rates per year. But with that caveat, let's talk a little bit more about the elements of credit cards. Credit cards fall under this type of credit called open-end credit. You can borrow up to a specific credit limit that the credit card issuer specifies, and as long as you make a monthly payment that's a minimum amount, then you're okay in terms of your credit score. However, anything that you don't pay off in full each month, if your minimum payment isn't your total statement balance, in other words, you'll have to pay an interest rate or finance charge on. And those interest rates can be quite high. Pay it off each month though, and you're not subject to an interest rate. So credit cards are typically issued by big banks, JP Morgan Chase, Wells Fargo, Bank of America, these types of places. Sometimes you also have store credit. These are credit cards issued by stores like Lowe's, Home Depot, certain gas stations, department stores, these types of things. These I don't, again, advocate really using. I guess the advantage of them is that when you're just starting out to get credit, these types of store credit is going to be easier to get than a bank credit card. If you don't have any credit card at all, you're more likely to be able to get one of these. And with one of these, you can start building your credit so that you can apply for and eventually get accepted for regular bank credit cards. So you don't have to go into debt, or you certainly shouldn't go into debt. You don't have to spend lots of money on these store cards. But if you can't get a regular credit card, you can start with a free, no annual fee store credit card in order to build up your credit score. You basically just keep the card around, you don't cancel it and don't lose it, and just doing that will, over a year or two, increase your credit score quite a bit. Outside of credit cards, there are these things called revolving lines of credit. You probably won't get to this until later in your life when you start looking at home equity credit lines, possibly unsecured personal loans, but the interest rates on these can be quite high as well. And so, again, absent an emergency, these things aren't really something that you'll necessarily want to use. Home equity credit lines, though, are maybe another matter, where in situations when you buy a house, you get a mortgage, you have a down payment. Suppose the house increases in value, then your mortgage hasn't increased. The mortgage stays the same. And so you can pull out that increase in value over and above the mortgage amount and over and above this down payment that you originally made. You can pull that out in the form of a home equity credit line. And the interest rates on these are generally more reasonable, and you can really do anything with the cash, whether you want to make new investments with it, whether you need to pay for some medical expense. It's if you have to borrow money, home equity credit lines can be a good option. And that's another reason for potentially owning a house in itself, is that you get the appreciation, but you can access that equity appreciation through a home equity credit line if you absolutely need it. And so just to illustrate this concept, suppose you bought a house for $300,000 and you from that paid a $10,000 down payment. Then at the time, that means the remaining amount comes from a mortgage. the rest of that purchase was financed from a mortgage. If the house, though, after you buy it, rises in value over the years to $400,000, well, you still have that $10,000 that you put when you bought it, and your mortgage hasn't actually changed. And so your equity is now that $400,000 minus the $10,000. Well, that's part of your equity, but your new equity is minus the $10,000, and then minus, what's claimed by the bank, the $290,000. So you get $100,000 in new equity if you subtract out these two. That new equity, which wasn't there before, you can borrow from against that using a home equity credit line. You can also do a cash out refinance, but we'll cover that separately. This type of lending here is called secured because it's secured on the value of your house. That's good and bad. The secured means it's a lower interest rate, but if you stop paying on your home equity loan, then the bank that lent you the money for the home equity line of credit can foreclose on your house. So they can take your house in order to recover the money that they lent to you if you stop paying. That's a secured loan because it's secured by the value of the house. So whether it's open-ended credit like a home equity line of credit or credit cards, it's good to manage these types of debts wisely. Key to doing that is to understanding the different components. For credit cards in particular, you have the statement date, payment due date, transaction and posting dates, and any unpaid balance left over. Statement date is when it's issued. Oftentimes you have, say, 15 days or so to pay before you're considered past due. Most of the time I just set it on auto payment and have the auto pay to pay off in full each month. And I just generally don't have to worry about all these mechanics. You could just pay the minimum payment due, but as we just discussed, for any of the payment that you don't pay, if you had $1,000 balance and you only paid $35, the remaining amount of money, the $965 in that case, would be subject to an interest rate charge. And that may be 20-30% a year. So generally it's better to just pay off the balance in full. One positive thing about using a credit card instead of cash is that you're not responsible for any charges. It says technically within the first 2 days, but really as long as you notify the credit card company that your credit card has been stolen or that you see fraudulent charges, notify them as soon as you see them. They'll generally refund you. I remember I had an old credit card that I hadn't looked at for 6 months or so, and I looked at the statement and someone had bought an airplane ticket using my credit card. And it was a little funny because they actually had their name on the purchase. The name on the ticket showed up as the name on the credit card purchase. But in any case, I submitted the request to the bank to say, hey, that was a fraudulent charge. And even though it was 6 months later, they still refunded me. So you have some nice protection, liability protection, like if your wallet gets stolen, using a credit card that you may not have using a debit card, and you definitely don't have if you've got just cash. I've never had an error in billing on my credit card where my lender, the credit card company, said I owed money that I didn't actually owe. But if that ever does come up, just be aware that you can correct errors on your credit statement. And with the credit reporting agencies, you have a right to kind of fight back for any errors that aren't your own. Okay, and then let's talk briefly about installment loans. Installment loans are just loans where you can, pay back at a lump sum at the end of the loan period, or you make installments, certain equal installments usually, of some interest and some of the loan amount back each month. These installment loans can come as variable rate or fixed rate loans. Fixed rate loans, you know what interest rate is going to be for the life of the loan. If it's 5%, then it's 5% for the life of the loan. Variable, that means the interest rate can change from month to month, from year to year. Usually they change based on whatever the economy is doing. If interest rates in the economy are up, then interest rates on this loan is going to be up as well. So for you, there's more risk with a variable rate loan. There are alternative types of installment loans. Generally, I would just avoid every bullet that you see on this slide, just because the effective interest rates on these are just astoundingly high. Okay, so this was a brief summary, but the point is that it's good to be money wise, and you can't avoid debt necessarily in this life, but you can be wise about the debt that you take on, what types of debt, and how much of it. And so we haven't talked about mortgages yet, but at least we talked a little bit about debt when it comes to credit card payments and other types of kind of unconventional loans and how to avoid some problems associated with them. Biggest thing, just make sure to pay off your balance on a credit card each month. Don't rely on credit cards as a way to borrow money. See them more as a way to have fraud protection against getting your wallet stolen, and a way to build up your credit score.